In transfer pricing, choosing the wrong comparable agreements for intangible royalty analyses can cost multinationals millions in adjustments and penalties from tax authorities. Today, we address a critical question. Do comparable agreements need to be from the same fiscal year as the analysis? Or can agreements from prior years still be valid and reliable? According to the International Transfer Pricing Framework, royalties agreed between related parties as consideration for the use of intangibles must be demonstrated to be arm's length, that is, reflecting the terms independent parties would have negotiated under comparable circumstances. One of the most widely used methods to test this condition is the comparable uncontrolled price method, or CUP. This approach requires aligning key factors between the controlled transaction and the comparable agreements, such as exclusivity, development and improvements, territory, license term, and other relevant provisions. Restricting the search to the same fiscal year makes it harder to find truly comparable agreements. So the key question is, can agreements from earlier years be included without compromising the reliability of the analysis? To answer this, we conducted a study analyzing more than 10,000 royalty agreements between independent parties using the Intangible Spring database, updated through December 2023. These contracts, signed between 1980 and 2023, were evaluated by comparing royalty rates across moving time windows of 5, 10, 15, and 20 years, with minimal sample sizes of 100, 200, and 300 observations to ensure statistical validity. The results are clear. The broader the time window, the greater the chance of finding significant differences. But in 5 and 10-year windows, the most common in practice, over half of the cases showed no significant differences. This indicates that using agreements from recent prior years is both technically valid and practically useful in most transfer pricing scenarios. The study also classified contracts by industry, using a 10-year window with a minimum of 100 observations. Industries analyzed included business services, consumer services, pharmaceuticals, and restaurants. The key outcome: only 15% of cases showed significant differences, confirming that industry-specific comparables greatly reduce variation. In conclusion, there is no evidence to justify automatically excluding contracts from prior years. On the contrary, using 5 to 10-year windows in combination with qualitative criteria, like industry for example, strengthens the analysis, expanding the sample size and improving reliability. If your company pays or receives royalties for intangibles, this type of analysis can make the difference during a review by the tax authorities. At QCG Transfer Pricing, we constantly challenge key assumptions in the international transfer pricing regime to design optimal solutions for our clients. Our research helps multinational groups build transfer pricing systems that are not only robust and defensible, but also deliver measurable value. Contact us for a no-commitment consultation.